The earnings season starts in full throttle this week, with most of the big banks lined up to announce their numbers over the next 8 days. The pre-results announcements show actually better than expected both deposit and loan growth for most of the big banks. The HDFCs, Kotaks, all of them have reported better than expected deposit and loan growth numbers. But markets are going to watch out in the actual results for the margins. And that may continue to shrink because the repo rate cuts pass-through is still underway. The added negative for banks could be that bond prices have fallen and therefore treasury income will not be a very big positive. Separately, of course, the Reserve Bank has announced a bunch of deregulation for banks, or you can call it ease of doing business. We will, of course, ask from bankers what they make of it in their post-results announcements. But to prepare us for the results season and for the year ahead, for the banks, I have with me Rikin Shah, Senior Vice President at IIFL Capital and a Master of Financial Sector. Thank you very much, Rikin, for dropping into our studio itself.
Thank you, Latha, for having me over.
Okay, well, let me first start up with this general thing that the Reserve Bank has announced, the series of deregulation, the ability to do acquisition finance, to give unlimited debt against debt securities, and, even ECB rules eased. Do you see that as a future rise in loan growth?
So, Latha, if you look at the regulations which were announced, which can potentially aid the loan growth, there were a few of them. The first one was they repealed 2016 circular restricting the supply to the large borrowers at the banking system level.
The 10,000 crore cap.
10,000 crore cap. But of course, the individual banks will still be governed by their large exposure framework. So this can potentially move some of the credit to the banking sector from the bond market in the longer term. But again, we think that banks are better off focusing on higher yielding retail and SME rather than superiorly higher rated corporates where the pricing is too thin. And as the bond market depends, this is unlikely to change it meaningfully.
What about acquisition finance?
So the M&A financing is, of course, one of the things as well, which now it is opened up to the banks. We'll have to see which large private banks who are better geared to, cater to this demand as well, especially the likes of ICICI, Kotak, Axis, HDFC, who have multiple financial conglomerate subsidiaries can cater to that. But again, we need to be very clear about the underwriting that you do here, because in the past, in the 2008 and in the earlier periods, we have seen that this can potentially lead to stress for the sector down the road if people go out after the leveraged buyouts, etc. So that's the second one. And the third and the final one is on the no caps on the listed debt securities. I think that's okay. So all in all, slightly positive. But I don't see the demand for the credit to go materially higher. So if I were forecasting 10.5% kind of a banking system loan growth, potentially 11.5 in a longer term, but not a materially significant positive.
Okay, I guess we will have to see the appetite of the conglomerates or of the companies who want to do acquisitions. Okay, now let me come to the results itself. The loan growth has surprised you also. Was it positive?
Yeah, absolutely. I mean, because if you look at the latest fortnight data available until 19 September, the banking system loan growth was 10.5% YOY. And most of the banks that have reported, they have reported loan growth which has beat our and consensus expectation by 2 to 4 percentage points. So the loan growth has been high. It probably could be due to two reasons. First is in the last fortnight, there was actual acceleration in system credit. Potentially led by festive demand or the postponement in buying due to the GST cuts. Or also secondly that not all the banks have reported the business updates, as some other banks like ICICI, SBI, etc. report the numbers. There could be some market share loss in for some of the banks who have not reported so far.
Okay. Oh yeah, that's possible. But let's take HDFC in particular, where we saw that mid-single digit loan growth for a whole year, for 4 or 5 quarters. You think that period of adjusting to the HDFC balance sheet is over and now we will start seeing the old HDFC Bank again?
I mean, still not there. Probably we are still a year away from seeing the balance sheet reverting to the pre-merger balance sheet levels. But clearly the worst in terms of very low loan growth, sharp decline in the margins and any asset quality issues is behind. So we have seen the loan growth accelerating from 3-4% to 8-9% right now. it's still lower than the system.
Lower than there, yeah.
And I think by next fiscal, when we reach there, they can probably start growing similar to or slightly faster than the system. So FY28, I believe, would be the first year when you'll see HDFC Bank reverting completely back to the pre-merger run rate on most of the financial matrices.
Now, if I remember right, that was Shashi Jagdishan's guidance about a couple of quarters during the results that in FY27 we will catch up with the system. But therefore, is it attractively priced because of the past?
Yes. So, from our medium to longer term perspective, preferred picks, the ones among the larger private banks which we like is Axis, ICICI and HDFC among the larger private banks and SBI among the PSUs. Of course, in the near term, there are multiple other factors at play as well. And given that you asked about valuations particularly, it is now trading only at 3-4% discount to ICICI right now. I think we are probably at least a year and a half away before we can have a debate whether HDFC should go back to commanding premium versus ICICI. But given where we are, I think the near-term relative outperformance could be kept due to ICICI not doing as well.
Okay. What should the investor look at? Perhaps HDFC Bank will not catch up in terms of margins also to its 4% plus scenario. Is a good ROA enough? I mean, if the ROA were to impress above 2, would that be good enough?
Yeah, absolutely. So as we speak today, the bank is doing 1.7, 1.8% ROA. There is no doubt or skepticism in our mind whether this can go back to 2% ROA. It will happen over a period of time as erstwhile HDFC Limited's 8.5% bond borrowings come up for maturity and you'll replace them. So that journey is there. I think what you'll see from any investor looking at the stock from a longer term perspective, HDFC has demonstrated that they are gaining sustainable market share gains over a longer period of time on deposit. Loans is a problem in the near term as they are adjusting their balance sheet. But once that is done, I think you will see a decent high-teen earnings CAGR growth trajectory for the bank.
Okay. What about mid-cap banks? We have pre-results from RBL and a few others. Did anything stand out for you?
I mean, so if we look at the business updates that were out, Karur Vysya, Bandhan and RBL reported loan growth which were anywhere between 1 to 4 percentage point higher than what the consensus was expecting. On the deposit side, it has been generally in line or weaker across most of the banks. Among the mid-sized banks, the one stock which we have liked and we have been recommending to investors is also RBL. Even for near term as well, our estimates are around 10% higher than the consensus.
Oh, okay.
And the bank is in a fundamental turnaround story wherein the ROAs are likely to improve from 0.5% as we speak today to 1% by exit FY26. There are a couple of other mid-sized banks like KVB, etc., which are also good banking franchise.
Okay. You're not impressed by the gold financiers? I mean, there's only one bank which stands out over there.
I mean, yes. So a lot of the gold financiers have had the tailwind of the gold prices, and you'll see a lot of them reporting very stellar loan growth backed by the increase in the gold prices. So yes, the growth should be very good for them as well.
If I remember right, in RBL, you're saying that is the only bank which may report rising margins. How will they do that?
So yes, Latha. So in this quarter, we are expecting banks to report margins in margin contraction of 5 to 20 basis points. On the lower end of the spectrum, you will have the PSU banks and a few private banks like Kotak, etc. But RBL bucks the trend and should be reporting 3 to 5 basis point higher margin QOQ. The reason why this is happening is mainly because of sharp reductions in the cost of savings account rate. So the last quarter, the cost of savings account rate was 5.8%. This quarter, you'll probably see that coming down closer to 5.4, 5.3.
Okay.
So any pressures on the loan yield will be more than offset by the lower cost of fund. And that is where you will see the margins starting to improve for RBL.
Okay. Well, to go back to the regulations which the Reserve Bank announced, they have also announced draft ECB rules, which seems to give the impression that banks with foreign branches will now be able to finance M&As and any end use from their overseas branches. Does that put BOB in a better position?
I mean, a lot of these banks like BOB, SBI do have the foreign branches and have the wherewithal to do this if it is required. So again, I mean, the large private banks, select PSU banks, they have the capabilities to do this. We'll just have to see how the appetite for this is and what the boards of this respective banks are comfortable in terms of underwriting this risk.
Yeah. Yeah, I know. I guess we're counting the chickens a bit too early. We don't even know what the final rules will be. These are draft rules, and there are a lot of grey areas. What's your sense about Kotak? I thought you all have upgraded Kotak.
Yes, so Latha, we had reduced rating on Kotak for almost 2 years, and we have recently upgraded and made it to a ad rating, which is more like a neutral rating. The thought process behind this recent upgrade is the operating backdrop for the banks is improving. We wrote this report sunny days ahead a month and a half ago where we said that operating backdrop for banks is improving. So naturally, the banks which were hurt more, either in terms of liabilities or asset quality, they'll see a better recovery vis-a-vis other banks where there was no problem.
Okay.
So for instance, the likes of Axis and Kotak have seen sharp deterioration in asset quality. As this macro backdrop improves, you'll see that this will be the beta names which do better, and hence we upgraded the stock to a ad rating. It still doesn't feature in one of our preferred picks from the longer term perspective due to certain reasons.
Okay. Yeah, I know Q1 was not very happy for them in terms of asset quality, and likewise for Axis. So you see those Axis Bank also reporting better numbers. Okay, finally, I wanted to ask you about PSU banks. You know, they've had a superb run of credit cost. And they had the advantage of, last quarter, very good treasury income also. This time the treasury income is not going to be good because we saw bond yields rising. I mean, the 10-year, I think, rose by 20-30 basis points from June 1st to September 30th. So both this, will credit cost advantage continue, and will, treasury income fall be very sharp?
Yeah, so the treasury income, I think it's pretty obvious that given this sharp spike in the GSEC, the treasury gains will be materially lower versus what we saw in 1Q. And 1Q was again an aberration. The numbers were very strong vis-a-vis the historical run rate. So no doubt across the banks, we'll be seeing them declining materially. We still, our discussions with the lot of treasury desks still don't suggest that banks will be reporting losses, but it will be materially lower. Credit cost, yes. I mean, nothing at this point still suggests that there is going to be any marked deterioration in the credit cost for these banks. From a near-term perspective, the only one pocket where I'm a bit watchful for PSU banks is micro MSME segment, where they have slightly higher exposure and historically the credit costs have been elevated. But again, it's not going to be as big a problem as retail unsecured because a lot of these are backed by hard collaterals and covered under the government guarantee schemes.
And they're small, even the total book. Just a final word. What is your, this is more a head of research question. Where does finance stock stand in IIFL's hierarchy of picks?
Until the report, the sunny days ahead that we wrote a month and a half ago, it was not featuring in one of the key recommended sectors. Since then, we have recommended investors to add more weights to the financials. So it is now one of the few sectors which we really like, especially because if you look at the banking sector in particular, we are talking about high teen earnings CAGR for next 2 years versus broader Nifty 13-14% earnings growth. And more specifically, the valuations are far more reasonable, 12-time PE versus 22-23 time. So naturally, it's now one of our recommended.
So finance has come up in the hierarchy. Thank you very much, Rikin, for that ending on that optimistic note. Let's see, next weekend, same time next Monday when we meet, we will have a bunch of banking results and we will see how they have done. That's it on this edition of Bazaar. Thanks for watching. After a break, Chartbust.